Good morning, everyone. Thank you so much for joining us for today's webinar. We have a great presentation for you today. We do have a handout that's available to you. It's in the Handouts tab. You can just expand the tab and then click on the file to open it and save it to your computer if you'd like. If you have any questions throughout the webinar, you can type them into the questions box and the instructors will get to them throughout the webinar or at the end. To earn CPE for today's webinar, please make sure you respond to the polling questions when they pop up on your screen. If you respond to all the polling questions, you will receive a CPE certificate via email in about 2 to 3 weeks. That's all for me, and I'll go ahead and turn it over to you, Ron.
Thank you, and welcome today to the Tax Cuts and Jobs Act, clarifying the rules and benefits of cost recovery. So on behalf of my fellow speakers, David McCallum, who is a manager in the Credits Accounting Methods team, and Anna Blake, who is a senior associate on the Credit Accounting Methods team, and myself as the partner and national leader, we welcome you to today's webinar. What we'd like to cover while we're together this morning is the following in our agenda. We want to talk specifically about the changes that were brought about by the Tax Cuts Jobs Act, signed in December of last year by President Trump, and the majority of those provisions, except for one retroactive provision, certainly impact when we talk about clarifying the rules and benefits of cost recovery. We'd like to take you through some live examples, and then we want to go through the differences as well as the similarities around Section 179 and the bonus rules, take you through some examples there as well. And then we also want to make sure that we're not overlooking that animal called 263(a) or the tangible property regulations, and what is the synergy or the crossover when we think about some of the changes that were made in the Tax Cuts Jobs Act, and now 263(a) is a little more than alive and well in the statute, and we'll take you through some comprehensive examples. So I'd like to turn over now to my teammate Anna Blake to talk to us about Section 179. Anna?
So over the next few slides, we're going to go through Section 179 and bonus depreciation and the new tax law changes. Section 179 relates to 1245 property, which is personal property such as furniture and fixtures and machinery. The property must be depreciable under makers and used in an active trade or business. The property can be new or used. The amount of Section 179 expense is limited to taxable income. Pre the Tax Cuts and Jobs Act, the amount of Section 179 expense could not exceed $500,000, with a phase-out beginning after $2 million of assets placed in service for the year. For property placed in service after December 31st, 2017, which is the post-Tax Cuts and Jobs Act table, the amount of expense increased to $1 million, with a phase-out beginning after $2.5 million of assets placed in service for the year. The new tax law also expanded the definition of Section 179 property to include HVACs, roofs, fire protection systems, security systems, and alarm systems. These improvements must have been made to a non-residential property and placed in service after the building was first placed in service. Section 179 is still limited to taxable income. Prior to the new tax law, bonus depreciation was only for new property. The original use of the property must begin with the taxpayer. The property has to have a recovery period of 20 years or less and depreciable under makers. The bonus rate was 50% with a complete phase-out after 2019. One of the major changes is the property can be new or used. We will go into more detail later in the presentation about used property. The bonus depreciation rates increase for property acquired and placed in service after September 27, 2017, with a phase-down starting after December 31st, 2022. The terms acquired and placed in service are two key terms that David will discuss later in the presentation. And this table shows the new bonus depreciation rates starting on September 28, 2017, with a 20% decrease each year starting in 2023 to a total phase down after 2026. And then we have our polling question number 1. Have you taken advantage of the increased bonus depreciation deduction on your 2017 tax return? Yes, no, or not sure? Hopefully everybody's put in their polling question. Since bonus depreciation is 100% through 2023, when would a taxpayer elect Section 179 expensing? When the old bonus rates still apply, electing Section 179 would still be beneficial. You would apply Section 179 first to the property and then bonus. As mentioned earlier, beginning after September 31st, 2017, HVACs, roofs, and fire protection systems, security systems, can qualify for Section 179. This is beneficial because these assets have a class life of 39 years, so they would not qualify for bonus. These improvements must have been made to a non-residential property and placed in service after the building was first placed in service. Also, bonus depreciation cannot be taken on any property that is used in a trade or business that has floor plan financing indebtedness, but Section 179 can be elected. Over the next few slides, I'm going to walk through an example of when to elect Section 179 versus bonus. The table lists out 8 assets, their place in service dates, class life, and cost basis. As you can see, there has been a cost segregation study performed on the building. A cost segregation is a process of identifying assets within a building that can be reclassified into shorter depreciation class. As shown in this table, this building was able to be broken out into 5-year and 15-year. A cost segregation study is a way to accelerate depreciation deductions, reduce current tax liability, and increase cash flow. Starting with the cost segregation breakout, even though the assets are placed in service after September 27th, they would only qualify for 50% bonus. Because the construction of the office building was more than 10% complete prior to September 27th. So the old rule, which 50% bonus would still apply. This is known as the transitional rule, and David will discuss later in more detail. The 5-year property will receive Section 179 since it is 1245 property. The 15-year property are land improvements, which is 1250 property, so 179 cannot be elected for that asset, but 50% bonus can still be applied. The 39-year property would not receive Section 179 because it is not 1245 property and would not receive bonus because the asset has a class life greater than 20 years. The furniture and computers have a place in service date prior to September 28th, so they would not receive 100% bonus, but they can still receive Section 179 since they are 1245 property. The HVAC and security system both receive a class life of 39 years, which eliminates the asset from bonus, and the assets are considered 1250 property, which eliminates them from electing 179. Lastly, machinery has a September 1st place in service date, which is prior to September 28th, so 100% bonus would not apply. So it would be more beneficial to take Section 179 and expense the whole amount instead of electing 50% bonus. As the table depicts, when 50% bonus is still an option for assets due to their place in service dates, we still need to consider Section 179. This table shows the same assets, but the place in service dates are now in 2018. In this example, we have determined for the cost segregation breakout that assets will receive 100% bonus because they started constructing the office building in 2018. So the 5 and 15-year property will receive 100% bonus. The furniture, computers, and machinery are placed in service in 2018, so they will also receive 100% bonus. The HVAC and security system are both 39-year property, which eliminates the assets from receiving bonus, but they do qualify for Section 179 under the new tax law. As mentioned earlier, we stated the property was an office building, so it is non-residential, and the assets were placed in service after the building was first placed in service. So just to recap, this table shows the old bonus rates. And as you can see, after 2019, bonus depreciation was going to be completely phased out. The Tax Cuts and Jobs Act gave us 100% bonus depreciation in the current time period with a phase down of 20% increments after each year between 2023 and 2026 until a total phase down after 2026. So this table depicts the new rates after the new tax law. So now over the next few slides, David will go to even more detail about the new rules related to bonus depreciation.
Thank you, Anna. So hopefully you guys grasp from those examples about the potential benefits of 100% bonus depreciation under the Tax Cuts and Jobs Act, but also the impact that 179 is still around if you get stuck with the old bonus depreciation rules, the pre-Tax Cuts and Jobs Act depreciation rules. It's really, the devil is in the details, and there's always going to be a few hurdles. So let's walk through these details for applying bonus depreciation to avoid tripping over any hurdles. So the bonus depreciation, you've got to have qualifying property. We're going to dive into exactly what that definition is on the next slide. You really have to track the date that the property was placed in service. And with the Tax Cuts and Jobs Act, the acquisition date is going to be incredibly important because that's going to be one of the requirements of whether or not you get post-Tax Cuts and Jobs Act bonus depreciation or pre-Tax Cuts and Jobs Act bonus depreciation. The acquisition date is going to be critical. Again, it's only going to apply to maker's property with a class life of 20 years or less, and a few other specified types of property that we'll get into in a minute. Another thing to remember that differentiates bonus depreciation from 179 expensing is there is no total cap on the bonus depreciation allowed in a taxable year. So if you have a bunch of qualifying property that is eligible for bonus depreciation, you are not going to get capped out. You could potentially use 100% bonus depreciation on all of that property, whereas if only 179 were applicable, you might not be able to take advantage of all of it because you're going to get capped out and phased down and maybe even phased out. Again, and the important thing to remember also is that bonus depreciation is now the default method, and if you do not want bonus depreciation to apply for whatever reason, some timing issues, NOL, something like that, then you have to elect out of the bonus depreciation scheme for assets that are placed in service during a taxable year in a single asset class. Another thing to remember is that, we said it's maker, so, bonus depreciation does not apply to intangible property, Section 179, or alternative depreciation property, ADS property. Okay, so qualifying property defined for bonus depreciation purposes, for 168K purposes. Again, maker's property with a class life of 20 years or less. The only kind of intangible that qualifies for bonus depreciation is computer software. Then we've got water utility property as defined under 168E5. so long as that water utility property is depreciated under Section 168 as well. Got qualified leasehold improvement property that is placed in service before 2016. And just a reminder, a qualified leasehold improvement property is, an improvement, interior improvement to a building that's used for non-residential purposes, and that improvement is made pursuant to a lease, and such portion is occupied exclusively by the lessee or sublessee. And the 3-year rule still applies. So the improvement has to be placed in service more than 3 years after the building was initially placed in service. Our next item of qualifying property for bonus depreciation purposes is qualified improvement property placed in service after 2015. A qualified improvement property is any improvement to the interior portion of non-residential real property if the improvement was placed in service after the building was first placed in service. Again, here there's no 3-year rule. It's just the improvement has to be made at some point after the building was initially placed in service. It could be 2 weeks after the building was initially placed in service. So that's where you just remember the 3-year rule does not apply to qualified improvement property. Next thing is qualified film under Section 181. We're not going to dig deep into this definition because it's crazy and it's long and there's a bunch of requirements and exceptions, but just know that qualified films that were placed in service, that means initially released, broadcast, or staged after September 27, 2017, that critical date, that is eligible for bonus depreciation. Ron, I'm guessing that was just a nice lobbying effort on the part of the film industry, or, we're taking away DPAD qualified films, so we'll give you bonus depreciation. Is that where that came from?
I think the actors and actresses had significant input from a obvious reason perspective. But yes, I think that the lobbying effort in the context of the Tax Cuts Jobs Act was heavily geared towards MGM and others of film production.
Thanks, Ron. We'll also cover what non-qualifying property is for bonus depreciation purposes. And so if you're depreciating property under a method that is not defined in terms of years, like a units of production depreciation method, maybe if you are talking about vehicles, auto manufacturer, and the quantity is typically mileage, any sort of depreciation method that's not defined in terms of years, like units of production, you're not eligible for bonus depreciation. Another one may be retirement, replacement, and betterment method. Those things are not going to be eligible for bonus depreciation either. Again, film, videotape that doesn't meet that Section 181 definition or was released, broadcast, or staged live before September 27th, 2017, that's not going to be eligible for bonus depreciation. In any kind of property that's subject to the anti-churning rules under Section 197, any sort of rate-regulated utilities are also not going to be eligible for bonus depreciation. And automotive dealers or other similar dealers who are using floor plan financing after 9/27/17 are also not going to be eligible for bonus depreciation. Okay, so now the key terms in order of whether you can use 100% bonus depreciation under the Tax Cuts and Jobs Act. It has to be acquired post 9/27/17 and placed in service post 9/27/17. Acquisition date is generally going to be the date the asset is purchased. There are a couple of complications when you have a self-constructed asset or there is a binding contract like an offer to purchase before there's an actual purchase. So for self-constructed assets, the taxpayer is deemed to have acquired the asset once construction has begun, and that is farther broken down into physical work of a significant nature. What we're really boiling down to here is when 10% of the property's total cost has been incurred, 10% of construction is complete essentially, then the taxpayer is deemed to have acquired that self-constructed asset or self-manufactured asset. So 10% rule, that's the transitional rule Anna was referring to earlier. So in order for property to be acquired, 10% of the property's total cost has to be incurred if it's a self-constructed asset, and that's under the 168K regulations. in terms of a binding contract that exists for the actual purchase date. So, there may be an offer to purchase, and then later the actual purchase occurs. That acquisition date is actually going to be determined by state law. And so, that's going to be an inquiry you're going to have to look into. The contract might determine which state, governs that offer to purchase. So that's something you're going to have to look into if there's a binding contract that exists before the actual purchases take place. In terms of the place and service date, that is generally the date the asset begins its use in the business. For a building to be placed in service, we're generally looking at that certificate of occupancy, when it was granted, and what the actual certificate of occupancy granted. Did it just let people come in and install the shelving, or was it a certificate of occupancy so customers could come in and start buying assets? That's what we're looking at there. Is the building being used for its intended function, and is it generating income? It's going to come into play with place and service date. Now, I will tell you that the IRS did lose a case called the Stein case not too long ago. It was a January of 2015 case out of the Western District of Louisiana. And in that case, the taxpayer, Stein, was a retail operator, and they sold home building materials and supplies, kind of like a Home Depot. And they had built 2 retail stores in 2008. And at the end of 2008, both of these stores had certificates of occupancy that allowed personnel to install shelving, racks, stock up the merchandise. But that certificate of occupancy did not allow customers to actually enter the building, and the stores were not open for business. Stein argued that the buildings were placed in service, and they took, wasn't bonus depreciation, but it was a similar type of depreciation. They took it in 2008. IRS was like, no. That building wasn't really placed in service until 2009, when you guys started letting customers in. District Court ruled in favor of the taxpayer and said that the IRS did not provide any direct authority that placed in service equaled open for business. IRS, instead of appealing the case, just issued an action on decision where they non-acquiesced to the case. Basically said they weren't going to follow the holding of the Stein case outside of the Western District of Louisiana. And they made 2 pretty reasonable arguments, actually. Their first position was that, the taxpayer's intended use of the building was not to house and secure racks and shelving and merchandise. It was actually to sell that merchandise to customers. So, one, that it was a retail store that wasn't open for retail purposes, so it wasn't really placed in service yet. And second, that, the IRS, that the court observed the condition or state of readiness that was, for a specific function. IRS argued that the building was readily available when it was for regular operation and income-producing use. Just to install shelves and, stock the merchandise was not ready for income-producing use. So the Stein case, while taxpayer advantageous, is, viewed harshly by the IRS, but it is something to consider, and there is kind of a gray area here for this place and service date. So, it's definitely something to pay attention to and monitor going forward. Now to some examples to see kind of the application of these rules in action. So we've got a Doggie Day Spa. Sue plans to start a new Doggie Day Spa. In July 2017, she purchases all of the equipment to run the business. On November 1st of 2017, she opens her door for her first furry clientele. How should she depreciate these assets? So again, we need to talk about acquisition date and place in service date. For the Tax Cuts and Jobs Act, 100% bonus depreciation apply. It needs to be both of those things that need to occur after 9/27/17. Here, she purchased all of the assets, before the federal tax law change, before 9/27/17. So she has to follow the old bonus depreciation scheme, the pre-Tax Cuts and Jobs Act scheme. And under the old law, she placed the property in service in 2017. So she's going to get 50% bonus depreciation on these assets. She's not going to get the 100, but since she placed them in 2017, she's also not going to have 40. All right, let's look at this example and slightly different facts. Again, same date for the asset purchases, for the equipment purchases, but this time she does not open her doors until January 18th of 2018. How should she depreciate the assets again? So we got the same problem here. We've got an acquisition date before pre-9/27/17. So she's got to follow the old bonus rules again, as if they're still in place. And since she didn't place the assets in service until 2018, under the old bonus rules, she's only going to get 40% bonus depreciation on these assets. So this is just a nice impact of where the old rules might still apply even in 2018, post the enactment of the Tax Cuts and Jobs Act. All right, let's look at another example. Example 3, high-rise apartments. So LBD Housing is planning to build a 100-unit apartment complex. They purchased the land in April of 2017 and began construction in July of 2017. By 9/27/17, they have constructed 25% of the building and incurred 25% of the total construction cost. So let's see what happens. These are where these transitional rules under the 168K regulations come into place for construction of the asset. So the placed service date of the asset, the acquisition date of the asset is going to be when 10% of the construction needs to be applied and the bonus depreciation rules, we need to look at transitional rules for acquisition date when 10% construction or total costs are incurred, and then departments are actually placed in service in 2018. All right, so what happens? Since construction started and surpassed that 10% threshold before 9/27/17, we need to follow the old bonus depreciation rules. And then we have our 2018 placed in service date, so we only get 40% bonus depreciation because of that phase down under the old rules, the pre-Tax Cuts and Jobs Act rules. Again, if the apartments would have been placed in service in 2019, it would have only been 30% bonus depreciation. If the apartments would have been placed in service in 2020 because there was some long delay in construction, there would have been any bonus depreciation available. The thing we also need to remember that Anna touched on with all three of these examples is, okay, we don't get 100% bonus depreciation. Can we utilize Section 179 expensing? Can we take advantage of that to perhaps get even better results? I believe that brings us to our next polling question. All right, polling question number 2. For assets acquired, does your company currently track acquisition dates and place in service dates? Again, this is going to be critical, particularly if you have some pre-9/27/17 acquisitions that weren't placed in service until 2018. This is going to impact your 2018 return. If you have some self-constructed assets that you maybe had an acquisition date of pre-9/27/17 or sometime around then, and they don't get placed in service until 2018 or 2019, this could impact you for a couple of years going forward. Could make the difference between 100% expensing or bonus depreciation, or 40%, or even 30% bonus depreciation. Ron, any thoughts on the interchange of the old rules versus the new rules and how long they're going to be impactful?
I think what we're finding in our practice is, obviously, with the retroactive date of September 27th and just the transitional rules around acquisition and placed in service, this is a significant area of, I'll say, confusion, which is one of the reasons we want to kind of demystify it today. Obviously, behind all this is the rate arbitrage between 2017 income tax rates and the 2018 rates. So we're looking to obviously accelerate from a depreciation perspective as much as possible. Clearly, this is one of the key pillars attributable to the Tax Cuts Jobs Act that really came out of what was referred to as a better way forward, whereby we know that on a temporary basis, i.e. 168K of the bonus depreciation rules at 100%, there's a window of time from a new and a used acquisition perspective that we can write off those assets of class life for 20 years or less. That was not an inexpensive proposition within the Tax Cuts Jobs Act. And so I think what we'll be evaluating, and I'm sure Congress will be evaluating as we get further down the road, is did this drive our economy forward from large entities making investments in CapEx and being allowed in a machinery and equipment perspective, really any class life of 20 years or less, to basically expense and have the government subsidize that, even in combination with the lower rates, that CapEx acquisition. That's why we have clearly seen some major companies that have really come out very strongly in the latter part of last year and early part of this year. So, whether it's an Apple or a Chevron, who have indicated that, in the next 5 years, we'll be spending upwards of, $2.5 to $5 billion in regards to our CapEx expenditures. So, we need to take advantage of it now from a planning perspective, but I think it'll be an assessment of where the economy is and, really 2022, 2023 as to whether we'll see this either extended permanently or that it'll cease and we may go back to the old regime.
Thanks, Ron. All right, so Anna had mentioned earlier that bonus depreciation under the Tax Cuts and Jobs Act, qualifying property now applies to new and used property. So despite the fact that that seems like a great benefit off the top of your head, there are some hurdles or some landmines with this application too. So let's kind of run through those as well so we can avoid some planning pitfalls. All right. So let's define used property. So property which is first-time use did not start with the taxpayer. So first-time use did not start with the taxpayer in issue, and so the asset must be considered new to the taxpayer, even though the asset itself is not new. What does the IRS say this means? Let's dig a little deeper. All right, so the taxpayer has not used the property at any time before acquiring it. So it can be reacquired by the taxpayer, I'm guessing. We might have to go back that far. The taxpayer did not acquire the property from a related party or a member of the control group of corporation. So we're going to need to look at the 267 rules and all that stuff. If there's some intercompany dealings, make sure that it wasn't a related party or a member of control group of corporations. All right, and then we get into some basis issues. If your basis is going to be determined in the hands of another taxpayer or in the hands of the seller or through a like-kind exchange, you're going to have some sort of stepped-up basis or carryover basis or basis that's figured by reference to the hands of the seller, then it is not going to be, it's not going to meet that definition of used property under the new bonus depreciation rules. So like-kind exchange property is not going to be considered used property and be eligible for bonus depreciation under the Tax Cuts and Jobs Act. So let's do a quick example to see how that is illustrated. So Dove Real Estate LLC acquires a new building via a new to them building via a 1031 like-kind exchange in January of 2018. Can Dove apply the new bonus depreciation rules under the Tax Cuts and Jobs Act 100% expensing as part of their cost segregation study? Unfortunately, the answer to that question is going to be no, because the basis that they got from the 1031 exchange is a carryover basis, and therefore it is not going to meet that definition of used property under the new bonus depreciation rules. So that is a planning pitfall that I'm sure is going to bite some taxpayers 2018, 2019. It's something to be aware of. If you really want to take advantage of the bonus depreciation, you're going to need to do some acquisition planning, how that acquisition is going to be structured, because you know, if your basis is going to be determined by reference to the seller, you're going to get some sort of carryover stepped up basis, then you're not going to be able to use the bonus depreciation. Still might be able to use 179 for pieces of it, but not bonus. All right, Ron, your show.
So, you know, a couple comments before we dive into an example and really what is the life cycle of a building from that standpoint. So remember that underneath depreciation and what are referred to makers under 168, there's a lot of history behind that. And there were many changes prior to really the recodification of the code in 1986. But amazingly, up and through the Tax Cuts Jobs Act, you know, we have been following the same basic set of rules for the last 32 years. So, you know, from an overarching concept, remember that depreciation, which is really what we're talking about in CapEx and lives and what's the class life of that asset, is really intended to mimic the decline in the value over time of that asset. So in essence, it was an economic depreciation in concept. So remember that when we think about makers, there's really two systems there, and we'll point this out because this certainly very specific to the real estate construction industry. So we know we've got 168A, which is really the general depreciation system under makers, kind of the default convention, if you will. And then we do have this animal out there that became very important and will be important as we look through the Tax Cuts Jobs Act and planning in 18 with respect to this alternative depreciation system under 168G. So just keep that in the back as we go, or the back of your mind as we go through this new construction example. So what we first want to do is kind of look at, well, what is the normal life cycle of a building? So, you know, we're going to start with the pie chart. As we know, we're going to either construct that building or we're going to purchase that building. Obviously, there's going to be different rules. We've seen some recent, you know, releases in regards to the construction of a building from an IRS perspective, and then obviously the, you know, kind of the old rules apply when we purchase. So when you think about that building and the life cycle, it really then goes into tenants in place. We go through some analysis on repairs and maintenance. We'll look at renewed or replaced tenants during the life cycle of that building. We'll have major repairs, and then ultimately we will either sell or demolish that building. So what we wanted to do in this example is really walk you through very specific examples that are now applicable. So what this image really depicts is the life cycle of the building, and then ultimately what occurs in a building during the life cycle of it. Whether that's a repair and maintenance item, or we're exchanging our tenants, or we're going through some major repairs like a roof replacement, and then ultimately what happens when the building is sold or demolished. And so we'll start with the premise that we have concluded or completed a cost segregation study on this. So all of you are familiar with what is a cost segregation study. You know, from a concept perspective, what we're doing is we're taking an asset that we're told has a 39.5-year or 27.5-year life cycle, and we're looking at that and making a determination with respect to the construction of the building from a structural perspective, is what by tax law can we reclassify from 39.5-year really into 5, 7, and 15-year property. So as you'll see on the far right-hand side, we have been able to reclassify about 12.5% of the building into lower class lives. So we're below that 20 years. And of course, there's a benefit there when we talk about now that asset is into makers. And so we've got accelerated depreciation. And so as you'll see in regards to the building, we had a $32.7 million building that we reclassified across those class lives, totally reclassifying about $4.1 million. But most importantly, you'll see here in the cash benefit, and this is where that arbitrage comment comes in that I made. It talks about the first year cash benefit or in essence, the federal and state tax savings. So we were through the cost segregation analysis when we acquired the building or potentially constructed the building, able to accelerate about $2.1 million of first-year depreciation difference. So again, back to that rate arbitrage, hopefully not in a C corporation environment where the arbitrage would be 14%, but at least we're in that pass-through entity arbitrage. Now looking at really the rates moving down to about 29.6 for those of you familiar that are with the 199 Cap A or the qualified business income deduction at 20%. So let's get a little bit more granular on the next slide. And this kind of tells us what the depreciation schedule attributable to the cost segregation is, shows the breakout of the cost seg. But the main item we wanted to point out on this depreciation schedule is what David just reviewed with respect to placed in service date and bonus depreciation. So note, since the placed in service date is after September 27th of 2017, so we placed it in service in November of 17, you may think, and we would think, that, well, we want to make sure we maximize, as we've reclassified assets into that below 20 years, we want to make sure we take advantage of 168K, and therefore we're 100% expensing underneath the 168K provisions. However, very similar to the rules that David walked us through, in performing the cost segregation study, we're in this transitional period. So we had to ask when the construction of the building began and when that 10% of the building construction had been completed. And what we determined in this scenario, as a reminder, is that if we achieve that, and it was prior to September 27th, we are not allowed 168K at the 100% level, but we're underneath the old bonus rates. And so we're looking at really a 50% bonus depreciation applied to these 12.5% reclassed assets across the 5, 7, and 15-year life. So during this timetable of transition from old to new, underneath the Tax Cuts Jobs Act, we needed to pay close attention specifically at a building's life cycle, as well as really in any asset that we're looking at that we may be thinking we could apply old regime, new regime, new and used. So this is just a summary. Do the cost segregation study. Again, we basically received bonus depreciation at the 50% level of around $2 million. And we were able to break that out into 5, 7, and 15 year. So the first year cash benefit, as we had already highlighted, using an 8% discount and a 40% tax rate, was about an $840,000 savings. So you can certainly calculate simply in a corporate or a pass-through entity on a permanent rate arbitrage, it's 14%. Hopefully not in a corporation do we have this asset, but in a pass-through situation, we're looking at moving that from 39.6 potentially down to 29.6, taking advantage of the QBI or the 199 Cap A 20% deduction. The other thing that I would mention, I mentioned this in the beginning, remember that the tangible property regulations, that animal that came about in September of 2013, it became final regulations effective January 1 of 14, is still alive and well, and we know those regulations tell us that when we deal with 1250 commercial property, we're dealing with units of property, not dissimilar to when we look at a manufacturer in a production asset unit of property review. So the unit of property in this context was determined for the building in the context of the cost segregation study, which of course is going to be beneficial as we walk through the life cycle of the building and we make determinations underneath the unit of property concept that was brought in the regulations as to whether I'm required to capitalize or am I going to be expensing that asset depending upon my unit of property. So let's ask ourselves the question, where do we begin? So David, comment?
I thought we had a phone question, but it's the next one.
Yeah, I was going to say, following questions, next slide. So where do we begin, just as a conceptual level when we are really beginning to think through? So the first thing, of course, we want to do is we want to consider what the de minimis expensing policy is. So as we know, the de minimis safe harbor is $2,500 per item per invoice for taxpayers without the applicable financial statement. That's that 2,500 de minimis rule where, the service is not going in the event of an examination to really scrub those assets. Remember, that's a 2,500 per unit. So, you could have 10 items at $2,000 on the same invoice, and you would expense those if your de minimis safe harbor was the $2,500. If I'm in a applicable financial statement context, the taxpayer can, in essence, elect to have the concepts of $5,000 at the AFS level and $5,000 at the tax return level, so that ultimately, remember, the de minimis policy is the same for book and tax. So just a differentiation there. But when we begin to do an analysis, when we think about either the acquisition of an asset or, in theory, the construction of an asset, we want to start with our de minimis expensing policy and what is that. Of course, the second item we then are going to move on to is to really consider the capitalization policy of the company. So unlike the de minimis policy, the capitalization policy, remember, can be different for book and tax purposes. So beyond the de minimis rules, the company may have either a higher threshold, and those can be, in fact, different for book and tax. The third area, kind of going back to my tangible property reg, is now where we're going to kind of enter this new world, or really the world we've been living in around the unit of property, which really requires capitalization versus expensing in the context of a number of cost incurred assets. So the rules will help us determine which repair and maintenance costs ultimately we're going to be required to capitalize, or those that we can immediately expense. And finally, remember that the expense requires normally capitalization. This is important when we get into partial dispositions to consider for older assets. So, for example, could the taxpayer partially dispose of an old roof if they had to replace the roof, and in what level are they either replacing or, in fact, repairing? So it gets a little bit complicated. So now let's go to the polling question number 3. Do you all have a system for evaluating the questions on the previous slide for capital expenditures? So, again, just to remind, de minimis, capitalization policy, TPR rules, and then ultimately the evaluation of consideration around partial dispositions. So the answer is, I hope you do, because it is an absolute requirement. I think there's some perception out there by taxpayers that basically say, well, gee, underneath this new regime, I don't need to really think about my fixed asset analysis any longer. I really don't need to necessarily keep up with them, but that is the furthest thing for the truth. So actually the polling question gave responses back that some do, but a significant amount do not. So I want to flip through the next slides at a fairly quick pace, but I want it to resonate. So when you think about years 2 through 25 of the life cycle of a building, what's happening during that life cycle is, of course, there's a fair amount of repairs and maintenance type items that are occurring. So as we know, if the expenditures under the de minimis or cap policy can be immediately expensed. If it is over the de minimis or cap policy, then we need to discuss or consider the actual repair and maintenance rules. So, give you an example. If a new carpet was put into some of the offices, the carpet can be expensed under the routine maintenance safe harbor under the tangible property regulations. And so that's where the evaluation of repair and maintenance type items kind of begins to fold in beyond just the determination of the class life of the asset, and whether we're going to use makers or potentially ADAS, and I'll mention that later. But the repair and maintenance obviously are heavy. So let's move now to kind of a pavement resurfacing example. So in year 5, the office building needed some work to the parking lot. So the owner spent, in our example, about $25,000 for striping and resurfacing the building. And so what would you think? Well, the evaluation which we have to go through is, is this expense over the de minimis policy? The answer would be yes. So it cannot be automatically expensed, greater than $2,500 or $5,000. So what does the tangible property rules tell us? This tells us that it is not a betterment to the unit of property. Now remember that every building has about 9 units of property in it, but with respect to the parking lot and hardscape, the capacity of the building's not been increased. The restoration after the end of the restoration, the life of the property, and there's not been an adaptation to a new use, often referred to as the Raby rules around restoration, adaptation, betterment or improvement. So in theory, we can now determine the owner can expense the payment, resurfacing and striping as repair and maintenance underneath the tangible property rules. And so that's also where the unit of property and the TPR rules come into place. So let's go through another quick example from an HVAC replacement perspective. So in this example, we are replacing 2 of the HVAC units. They stopped working, and of course, they needed to be replaced because we're sitting there in a hot day. So what's our analysis look like here? So again, going to that unit of property concept, the HVAC is 8 building systems, remember, around the unit of property. So we've got to determine first what was the number of the HVACs in the building to determine if the HVACs can be expensed or capitalized. The building has 4 units in our example. Replacing 2 of them would mean we're replacing 50% of the HVAC units, which is over the general rule of 30% as we're looking at a building system and being able to deduct it given that it was replaced or whether we would need to capitalize it. So now we've got 4. We've added 2. We know we can't expense those 2. So now we have 6 units, the 4 original HVACs, and then, of course, the 2 new HVACs. So the opportunity underneath the tangible property regulations here is we can use that property schedule provided within our cost seg study to determine the cost of the HVAC system and partially dispose of those 2 original units that are being replaced. This is often what's referred to as a partial disposition study. So that becomes even more important than a unit property analysis been done in the context of a cost recovery or an asset scenario. So obviously in the course of the life cycle, we have tenant turnover, and I'm going to turn it over to Anna and let her walk us through a couple other examples.
So tenant turnover has occurred in the office building. One of the tenants in the office building went bankrupt, and the owner was able to lease the space to a new tenant. The owner was able to remodel the space with the new tenant's specifications at a cost around $67,000. So how would the tenant improvements be classified? Since the owner capitalized the first tenant's improvements, a majority of the new tenant improvements could be expensed. After looking through the detail of expenses, none of these expenses were a betterment to the building structure and can be expensed. The treatment of the tenant improvements are determined on a case-by-case basis. The credits and accounting methods team can help to assist to determine whether the work is a capital improvement or can be classified as repair and maintenance expense. And in these cases, we look at invoices or any type of description to show what kind of improvements occurred, the cost, and the detail of how intense the improvements were. So now, we're at the end of the building's life. After 25 years, the owner decided to demolish the building and rebuild. As stated earlier, since we placed the asset in a general asset account under the TPR rules, this election allows the owner to continue to depreciate the building until the end of the 39-year life of the asset, instead of including the remaining undepreciated basis of the building into the basis of the land. So they can further depreciate it, which is an expense each year, instead of it going into land, which is not depreciable. So now on to polling question number 4. Do you have a better understanding of the tax benefits available throughout the life of a capital asset? And now I'll pass it on to Ron, and he'll talk about what you can do now to benefit from these items.
So just an overview. The polling result indicated that we achieved our objective. About 90+% of you indicated you have a better understanding, a better feel. Hopefully you understand it's a lot of moving parts when you talk about the de minimis rules, the TPR rules, the new 168K rules, the 179 rules, et cetera. So what can you do now? First of all, you're going to want to update your tax depreciation records now, January through May, and really look hard at additions and disposals. So we're in a new world underneath the Tax Cuts Jobs Act. We need to make sure we're documenting acquisition dates and placed in service dates for the transitional rules. We must consider the new expensing benefits for asset acquisitions of used property. Remember the new and used rules of 168K that David covered. And just remember that before engaging in like-kind exchanges, we need to pay special attention to dealing with real property and non-real property, because we know that now underneath the Tax Cuts Jobs Act, we're only dealing with real property. At the end of the day, if you've not had a cost segregation study done on any commercial building or multi-residential building, the unit of property analysis is critical as we went through the life cycle of a business. So a lot to consider, a lot to continue to evaluate. We did not have time to cover this today, but remember there's this animal out there, which is the interest expense limitation, 163J, and there's a number of elections around alternative depreciation systems and straight line that assist taxpayers to potentially not get caught up in that 30% interest limitation. So on behalf of Cherry Bekaert and behalf of the Credit and Accounting Method team and my co-presenters of David McCallum and Anna and myself, we want to thank you for spending an hour with us. If you have any specific questions, please feel free to reach out to any of us. We have our emails there. And again, we want to thank you for attending the webinar today. And we have a number of coming up as a firm, and we'd encourage you to attend those as well. So thank you very much, and you all have a great day.